while rising geopolitical tensions in West Asia are pushing global oil prices higher, raising fresh concerns for China's economy, and the military confrontation in the Gulf has heightened risk to a region which is critical for global energy supplies and maritime trade. Brent crude has surged over 16% since Friday to trade above $84 per barrel. For China, the world's largest crude oil importer, this sharp rally could mark a turning point. While higher oil prices may lift inflation in an economy battling deflationary pressure, they also increase the risk of stagflation. This is a scenario where rising prices collide with slowing growth and rising unemployment. China has been grappling with weak domestic demand and entrenched oversupply. The country's consumer price index remained flat last year, and this was largely due to falling food and energy prices. Higher global oil prices could reverse that trend, and economists warn that prolonged elevated crude prices could push up production costs, potentially forcing factories to cut output and jobs, even as consumer prices rise. Now, this echoes past oil crisis that triggered stagflation in oil importing nations. However, analysts say that China is relatively less vulnerable to oil shocks as compared to its regional peers. The country benefits from a diversified import base, growing domestic production, and state-managed retail fuel pricing that helps cushion volatility. With the annual two sessions meeting underway, policymakers are expected to set economic targets for 2026. Inflation is likely to remain capped at around 2%, unchanged from last year's reduced benchmark. Economists suggest that Beijing may respond with supply-side measures such as tax relief to offset rising energy costs.